We still have a pretty robust jobs economy. But from everything we discussed before about the uncertainty of where we are in the tightening cycle, what comes next, what does that say to an investor?
Well, right now we're in an in-between stage right now, right? So if you go back just not too many months ago, it became evident that we had a self-sustaining inflation, that there was going to be a tightening in monetary policy. The markets priced that in, yields went up. You got the tightening of policy. It's still happening. It's not over. Markets got a little bit excited about the dip in some of the inflation. They started to bite on that yield, but we've already given up half of the yield rise that occurred, and that actually means the Fed needs to do more than if the yields had stayed up where they were, right? Including equity. So we're still in this thing. We're still in this tightening cycle. And like I said, there's going to be a mixture of three things, and you don't know what the mix is yet because it's too early to tell, but you're going to get some mixture of weak growth, high inflation, and rising interest rates. The more the interest rates rise, the more it's the weak growth. The less the interest rate rise, the more it's the high inflation. And if the Fed takes the foot off the brake, that inflation improvement's going to go away, and they're going to favor growth. So you don't know how they're going to play it quite yet. So what we try to do in this kind of environment is maintain some balance, right? Diversification, obviously. Not too heavily committed to any one direction, but also even within the equity market, structuring equity portfolios that have a cash flow and balance sheet base under them, so that if the tightening is very aggressive, that there's a strong enough balance sheet to hold that up, to sustain their position in the markets, or sustain a positive cash flow. And I think that the companies that have a lot of debt in relation to enterprise value or vulnerable profit margins, that sort of thing, are the type that are most vulnerable for that environment.
So it sounds like an awful lot hinges on the Fed. Surprise, surprise. Jackson Hole coming up next week, okay? A lot of people are going to pay attention to Jay Powell, what he has to say. If you remember last year at this event, he was talking about transitory still. That doesn't work so well this year.
Right.
So how much guidance can the Fed give us about exactly where they're heading on some of the questions that Bob just talked about?
Well, it's hard to know. I do think we're going to get a financial crisis somewhere pretty soon. It's always been part of the tightening cycle. But like you point out, David, last year it was really about transitory. He had what you went through, 5 different things that were proved transitory. And I personally think the Fed is now on the other side of the wrong foot. Now they're doing the entrenched. And a year ago I thought bond yields would go to 5% and Fed funds go to 5%. And I'm not quite sure what's happened, but money growth did slow dramatically, and commodity prices have come down dramatically. And now I'm seeing pricing power coming down. And so I think we've made a lot more progress on inflation than I expected. And that's why the market was going up until today. But that's if inflation keeps coming down, then the market is going to appreciate that.
So one thing I don't understand, Bob, we heard why Ed thinks the Fed's job maybe has gotten a bit easier, actually, with some of the things that have happened. But financial conditions actually have not tightened. Actually, if anything, they've gotten somewhat looser. That makes the Fed's job harder, does it not?
In recent weeks.
Yes.
Yeah, I mean, the first half of the year, literally the first quarter, the markets were doing the Fed's job entirely.
Yeah.
And then the Fed joined in, and once the Fed joined in and the market saw some, positive signs of inflation, they actually pulled back. And so bond yields came back down, equity yields, came back down. And so, that, as you said, about half of the tightening that the markets were applying has been retracted. Mm-hmm. If yields had stayed where they were, it would be that much less that the Fed needs to do. But the fact that the yields have actually dropped some and kind of given back some of the work that they were doing, it's that much more that the Fed needs to do. And so I think, Ed referred to you raised it, and we talked about last year's Jackson Hole speech, but they were clearly wrong about transitory inflation. If you actually look at the indicators that they follow, and they tend to be lagging indicators, I haven't heard yet an explanation about how they think inflation, why they think there is an inflation, why they think that that was wrong. And I think that that caused you to question how well this process is going to be managed. It's going to be very tricky.
Well, and that's a really powerful point, I think. Does the Fed need to explain to us what went wrong and why they're not going to do a mistake again for us to really believe them this time?
Well, it would be helpful. But, you know, from my vantage point, as you can see, what they missed was that fiscal stimulus, quantitative easing led to a 30% increase in the money supply, and that did it. And if you look back at that Jackson Hole, they completely missed that. Now, money growth is plunging, and commodity prices are coming down, all sorts of signs, and early signs. And so the job's not over by any means, but there's progress. And if you look back, like particularly at the 70s, when inflation peaked, the stock market started to respond to that when you had a very high inflation period like we have now.
Do you agree with Ed that in all likelihood we'll have some sort of financial crisis, that that's what happens in serious tightening cycles?
Odds are pretty good, yeah. Yeah, I mean, we haven't had enough tightening yet to really have that, but odds are good, yeah. I mean, we haven't had the downturn yet. If there's going to be a downturn, it hasn't happened yet. It's going to be hard to bring inflation down. How are you going to bring nominal spending down from 10% to 5% without a significant contraction in credit? You need to slow credit growth by about half. Money growth is slowed, but you need to slow credit growth in half, but it's still rising. You're going to have to hold interest rates up enough, and that's when bad things happen.